What would your portfolio say if you gave it a performance review tonight? Imagine sitting down after dinner, pulling up your investment statements, and really asking, how am I doing? Not just in dollars and cents, but in alignment with your goals, your risk comfort, and what the future might throw your way. Welcome to the Capital Breakdown, where tonight we're diving into how to audit your portfolio in one evening. This isn't about complicated math or financial jargon. It's about practical steps you can take right now to check on your money's health. Think of it like a car tune-up or an annual physical. Your portfolio needs its own checkup to keep running smoothly. We'll break down what to look for, how to spot trouble or opportunity, and why rebalancing might be your best friend. So grab a notepad, settle in, and let's get started on this straightforward, empowering journey. First up, start with your investment goals. It's easy to get lost in numbers, but what really matters is why you're invested. Are you saving for retirement 30 years away? Or maybe a down payment in 5? These timelines shape everything else. Someone planning retirement decades out often leans more into stocks because they tend to grow more over time, even with ups and downs. Think of it like planting a tree. Decades let you weather storms and enjoy the shade later. But if you need that down payment soon, your portfolio should behave like a well-kept lawn. Stable and ready to use, favoring bonds or cash that don't swing wildly. And remember, goals can shift. New jobs or family changes might move your timeline or priorities. This step is like drawing the blueprint before building a house. Without it, you're flying blind. So take a moment, review your goals, write them down if you haven't, and let that guide your portfolio checkup. It's your North Star for every decision. Next, gather your info. Pull up your latest statements from brokerage, retirement accounts, or apps. Look at overall allocation. How much is in stocks, bonds, cash, or other assets like real estate funds or commodities? Don't worry about exact numbers yet. Just get the big picture. Picture your portfolio as a fruit salad. Stocks are apples and berries, sweet with growth potential, but sometimes tart. Bonds are bananas, smooth and steady, giving balance. Cash is melon, refreshing and ready to use without fuss. Other assets like real estate or commodities might be nuts or citrus, adding variety but usually smaller portions. If one fruit dominates, does it still taste right? For example, a salad that's 90% apples can get overwhelming and unbalanced. Gathering this info helps you understand what's actually in your mix and whether it suits your appetite today. With your data in hand, assess performance, but look beyond raw numbers. A 10% gain sounds good, but what benchmark are you comparing it to? If the market rose 15%, you underperformed. Conversely, a 5% drop when the market fell 10% might be solid defense. Context matters. Imagine two runners. One finishes in 10 minutes, the other in 9. Is the slower runner losing? Not if the race had obstacles or tough conditions. Also, consider risk. Did you feel uneasy during dips? Some investments swing wildly, others move like a steady ship. Your comfort with these ups and downs counts. It's like judging a car by speed and smoothness. Think how your portfolio's performance matches your expectations and feelings. Did a drop cause sleepless nights or rash moves? This clarity helps avoid knee-jerk reactions later. Remember, investing is a marathon, not a sprint. Now diversification. Fancy word for not putting all eggs in one basket. A well-diversified portfolio spreads risk across asset classes, stocks, bonds, maybe real estate or commodities. Within stocks, diversification means exposure to different industries and company sizes, not just one sector or stock. Why? Different investments react differently to economic events. For example, if a big tech stock dips, utilities or consumer staples might stay steady or rise. Think of it like a sports team. If your star player's off, a strong bench keeps you in the game. Diversification smooths bumps and lowers risk of big loss. Checking your portfolio's diversity tonight is crucial to avoid surprises. Like a balanced diet, too much of one thing causes problems, but a good mix keeps you healthy. Here's where rebalancing shines. It's a powerful tool. Over time, some investments grow faster, throwing your allocation off. Maybe stocks surge to 70% when you plan 60%. that extra risk might not fit your appetite. Rebalancing means selling some overweight assets and buying more of the underweight to return to your target mix. It's like pruning a garden. Cut back wild growth and nurture what lags. This disciplined move locks in gains and keeps risk levels steady. Imagine planting tomatoes, cucumbers, and peppers equally, but tomatoes explode and crowd the space. To keep balance, you'd trim tomatoes and boost the others. Rebalancing isn't market timing, it's staying true to your plan. Up next, cost check. Fees quietly eat into returns, so look closely. These include expense ratios for funds, trading commissions, or advisor fees. Even a small 0.5% annual fee adds up over time. Think fees like fuel efficiency. A gas guzzler drains your wallet faster. A hybrid saves at the pump. For example, $10,000 invested with 0.5% fees costs $50 a year. Not much, but over 20 years, compounding can cost thousands. Low-cost index funds often shine here, but some active funds justify higher fees with strong performance. Research that carefully. Tonight, note your fees and consider if they match what you're getting. This helps keep more of your earnings and avoid expenses dragging you down. Don't forget tax implications in your review. Different accounts and investments have varied tax treatments. Selling in taxable accounts can trigger capital gains taxes. Tax-advantaged accounts like IRAs or 401ks defer or shield gains. Dividends and interest may be taxed differently depending on investment type. A smart audit includes understanding where tax exposure lies. Not about tricks, but awareness. Imagine your portfolio as a garden. You want to know which plants need extra care to avoid pests. Knowing taxes helps you plan moves so you're not caught off guard at tax time. For example, selling a stock that doubled in a taxable account may owe taxes, but holding it in a tax-advantaged account defers or avoids them. Understanding where holdings sit lets you strategize selling or rebalancing with tax efficiency. Let's get practical with a sample portfolio. Imagine 70% stocks, 25% bonds, 5% cash. Stocks soared 20%, bonds gained 5%, cash flat. Now allocation is 75% stocks, 20% bonds, 5% cash. That might mean more volatility than intended. If your comfort zone was 60-35-5, this drift signals a rebalancing chance. Think how this affects you if a downturn hits next. Would you panic if stocks dropped 15%? Or hold steady? Running this scenario tonight helps you prepare emotionally and decide calmly, not from panic. This is the kind of exercise the capital breakdown urges regularly. Simulating reactions builds resilience and confidence, as important as the numbers. Next, consider your holdings' quality and risk. If you hold single stocks, especially volatile sectors, ask, does this fit your risk tolerance? Single stocks can offer growth, but are riskier than diversified funds. For example, owning shares in a startup biotech can bring big rewards, but also big swings or total loss. Using leverage or options changes your risk dramatically, amplifying gains and losses, sometimes beyond your initial investment. If your portfolio feels like a roller coaster, it might be time to reassess. Like you wouldn't drive a race car without training, complex investments need understanding and comfort with swings. This step ensures your investments match your risk tolerance and goals, not chasing excitement or quick profits. Now, look at your portfolio's fit with life changes. New job, major expense, or shifting goals, closer to retirement or planning for a child's education. These shifts should influence strategy. Younger investors might tolerate more volatility with stocks. Near retirement, preserving capital is key. If your portfolio doesn't reflect these changes, it's like driving with an outdated GPS. You might go off course. For example, new parents might add stable investments or boost emergency savings for upcoming expenses. Someone starting a business might need more liquidity. Note your current life stage and how your investments match. This keeps your portfolio relevant, responsive, and aligned with your real needs. Periodic reviews keep your money working with your evolving story. Here's a quick checklist to wrap your audit. First, review your goals. Are they clear and current? Second, confirm asset allocation fits those goals and your risk comfort. Third, Assess performance with context, not just numbers, but benchmarks and feelings. Fourth, check diversification. Do you have a healthy spread? Fifth, evaluate costs and fees reasonable. Sixth, understand tax impacts managed well. Seventh, consider holdings, any concentrated risks or complex instruments. Eighth, factor in life changes. Does your portfolio still fit you? Running this checklist tonight turns confusing numbers into a clear financial picture. It's about clarity and control, the core of smart investing. For example, if you find your portfolio heavily weighted in one sector or stock, note it and plan to diversify gradually. Or if fees seem high, research lower-cost alternatives. This list becomes your roadmap for ongoing portfolio health. Before we close, a reminder. This episode is education only, not personal financial advice. Everyone's situation is unique, so do your own research and consider consulting a qualified financial professional to tailor strategies to your needs. Auditing your portfolio isn't a one-time event, but a habit, an ongoing conversation with your money. The more you engage, the more empowered you feel. The Capital Breakdown is here to help you build confidence and understanding, so your portfolio can serve you well over time. Tonight, take that first step, open your statements, ask the tough questions, and get ready to steer your financial future with calm and clarity. You've got this. Managing your money is like steering a ship. You don't just set the course once and walk away. You adjust sails, navigate storms, and enjoy the journey with steady hands on the wheel. Keep showing up, and your portfolio will be a reliable partner for years to come. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.